puppy's hot.
Welcome to another episode of Canadian Mortgage Hangout TV. My name is Gordon McCallum. I'm from First Foundation in Edmonton. I'm joined, as always, by the lovely, the debonair, the dashing, the Rob.
Oh, hi. Hi, guys.
What are you polishing, Rob? Tell us about it.
Oh, just something that's a little dirty here. I just had to polish that up there. That's just a little wee bit of a something I may have picked up in Las Vegas. We're gonna put it right here beside me.
Thank you for showing it to us. Unfortunately, even though you're a social media leader, the videos.
Here we go. Hold on, guys. I'll get the mouse to run on the wheel a little harder and clear up that pixelation. Dick.
So, Rob, tell us what. Seriously, in all seriousness, what's it for?
Well, as we talked about this off air, and as always, I don't want this to be a brokerage, super broker chain focused episode. I will say that the lovely people at Verico, at the event that they held in Las Vegas last week, awarded me and Scott Dawson together as Social Media Leadership Award winners. And I'll say this on air because I know I sent you guys a message as well privately, but I'll say it on air for the record. It had nothing to do with you guys. No, absolutely, CMH TV. We're coming up on our 2 years at CanadianMortgageHangout.tv. By the way, if you're watching this live, you can follow and questions on the Twitter with the hashtag CMHTV, or this video will be in perpetuity on our website, CanadianMortgageHangout.tv. But as I said to you guys in private, and I'll share this live, this award that Scott and I both got is shared with you two gentlemen because I can't help but feel that a lot of the reason that we got this award was for the work that you guys put in. I do no work with this show. I just come on here, crack some jokes, and look good. You guys do a lot of work, and I appreciate that, and I appreciate everybody watching. Believe it or not, at the conference, had a lot of people say, "I watch you guys. I don't watch it live, but I watch it on the weekend or in the evenings or whatever." A lot of people said that. So, and unprovoked too, just randomly walking up saying, keep up the good work. You guys do an awesome job. So, thanks, guys.
Well, thanks to all the people who watch us at their leisure at CanadianMortgageHangout.tv. And as Rob mentioned, follow us live, follow us later. We love the questions. We love to know your ideas for topics of conversation to have on the show. Get in touch with Rob, myself at Gordon McCallum, or the Kilted Broker at the Kilted Broker, who manages a lot of our social media stuff for us. Jackson, what's new and happening in your part of the world online?
Again, we talked about that castle last week, and I don't want to beat a dead horse, but if you're a broker and you have any type of email list that you use to communicate with your followers, you need to be brushing up on Castle. We talked last week a lot about it. We had an episode dedicated to it, and honestly, it's I'm starting to get a lot more correspondence. I actually do sign up for email lists, and it's funny how many of the marketing lists that I'm on are kind of all about, the Canadian anti-spam legislation and best practices and how to follow it. So there's certainly a lot of information out there. Our show was just one of them, but please don't be caught in an ugly spot, sending unsolicited emails, because what's the top fine? $10 million?
$100,000 to $10 million. So Castle, just for those of you, if you're turning in for the first time, Castle, C-A-S-L, it's not like where the Friendly Giant hung out. It's Canadian anti-spam legislation. And if you don't know about it right now, get on your horse and ride to the internet and look it up, because it's big time important. And I'll just give you a little perspective. This morning I was up early. I was at one of those 7 a.m. breakfast meetings that everybody loves to go to. And I was at this thing, and nobody who wasn't a First Foundation person at this thing, nobody knew about this. Accountants, we had accountants, financial planners, life insurance people, like event planners. We had all kinds of, the whole room is full of business people who don't know about this legislation that's coming into effect in 3 weeks. that has a major potential impact and compliance aspect to it for every business. Forget just mortgage brokers, forget the stuff we do. And thank goodness, thank you CAMP, thank you AMBA, thank you all the provincial associations out there for informing us about it. But we still have the responsibility as business owners in this industry to get our act together, or to make sure that we're compliant. Because guys and gals out there, you do not want to mess with this.
So I'm going to throw this out, Gord, because I happen to use social media as a conversation point. A couple of years ago when Twitter was new, I of course got my Twitter account, and I used that to bridge the gap with my business partners. When you go out for coffee with somebody and you're looking for business, and all you talk about is what you do, who you are, and how they can help your business, that's not a very productive business meeting. The goal of any business meeting should be to add value. Adding value doesn't always talk about what you're doing in your business. So if you have studied, researched Castle, take out some of your closest business partners, accountants, realtors, people that are in your network that you've got a good relationship with, and work through it with them. Say, hey, are you aware that this is going on? And be that valuable source of information. And it's funny, I did that with social media, and that's how I pretty much built my business. I'd go out and teach somebody how to use Twitter. Well, what do you think they do? They go and they tweet about you, and that's kind of, you don't tell them to, but that's just what they do. You go out and teach somebody about Castle, the next time that person has a conversation with someone else, yeah, this broker I know, he taught me about this, and then that's how business is done. So yeah, certainly if there's people that aren't.
Come to think of it, though, you may not want them to tweet about you because that's probably finable under Castle. So,
okay, so keep that on the down low. The principle's there that what you want to do is you want to be that important source of information for your business network, and don't always talk about yourself.
Come to think of it, now that I had this experience this morning at the breakfast meeting, I'm thinking that the first thing I do after I get off this show with you guys is I'm going to send an email. Business to business email to the people in my Bob Club, the people in my breakfast group, with a link to the Castle show we did last week. If you're watching and you missed it, you can find it again, CanadianMortgageHangout.tv. Look that show up. To me, that's one of the most important shows we've ever done. Was it last week or the week before?
It was definitely last week.
Last week, thank you. I blame it on the concussions, but that show is one of the most important ones we've ever done, just because I think of the impact it could have, both positive and hopefully avoiding the negative for our colleagues in the industry. So we don't want to hang on too long, but watch last week's show if you're at all interested. It'll at least give you a primer, but then talk to your lawyer, talk to industry people, talk to your association, and figure it out, get it handled, because you can't stress that enough. Rob, let's talk about you and Scott. Scott is still recovering from the celebration of winning the Social Media Leadership Award, which is why he's not with us today. But shout out to you, Scotty. Tell us about the conference in Vegas. How did it go?
The conference in Vegas was an awesome experience. Where do I start? Everybody that was there that was not part of our network said that it was one of the best conferences put on by a super broker, which it was my first kind of AGM / big event out of town event that I went to. So they kind of set the bar with me at that. So I'm sure if I go to other things, I'll go, man, this is crappy. No. There's some big takeaways I got from going to an event like this. So if anybody's a newer agent, or even in the agent for 10 years or 15 years, the main takeaway, and there's the reason I went. The main reason I went was to be shoulder to shoulder with people in our industry that have been in this industry for many, many years. There is not, as a broker owner, or as somebody who's a seasoned vet in this industry, 20 years, 25 years, you can't get in the same room with those people for 3 days. 3 days. You can't. There were so many little mini conversations I had at lunchtime, at 2 in the morning, still kicking around out in the lounge. You bump into people. I had a great conversation with Hallie from FizGuard. who is nominated as one of Canada's top 100 trailblazer women.
And who we're going to have on the show soon.
Absolutely.
Good word from Hallie herself. She's going to join us one of these days. She may not know what she's in for, but hey.
Yeah, no, and you know what? She'll be a great guest, and I mean, such a wonderful person too. Yeah. Geez, I talked to so many people from one end of the country to the other, and if there's one thing I could tell you, it's definitely these events. Whether you're with, it doesn't matter what chain. You know, I've seen DLC University events. Same deal. Go to these events in your networks. Go to the CMHC events in your cities. Go to Lender Breakfast if you can. But you know what? Go to your network events as well, because we're all colleagues in arms. And boy, oh boy, some of the takeaways, and a lot of people saying they're going back to basics. Back to basics. Calling clients on the phone. No email. One broker who will remain nameless, that has been in the business for a long time, does not email clients. All over the phone. All over the phone. Get them on the phone. Let them hear your voice. Smile into the phone. And that's how they do business. And they're not doing $20 million a year. They're doing a lot of business a year. So you know, there's another, you know, Usury, who have we had Usury on our show?
Unfortunately, no. He's a friend of the show.
Absolutely, Usury Bisada.
When we were talking with him in Toronto, he said he'd love to come on the show. All we have to do is invite him.
Oh, absolutely. We'll be having him on for sure. I had the pleasure of speaking with him, but he also did a social media and kind of a social media and marketing presentation at the event as well, and really good content. Like, I've sat through, as I'm sure you guys have as well, countless social media / digital marketing presentations, and 99% of them are yesterday's news. Like, the sources are from 2008.
How to log into Twitter.
Yeah, like, here's how you retweet. You know, really 101 basic stuff. Usury, really, really good presentation. I think another main takeaway is, don't be afraid of how you're doing business or tweaking it just a little, but don't fray into the new venture as well. If you are that guy or gal that only calls clients and doesn't email them and doesn't text message and doesn't Twitter and doesn't all of that stuff, but you're still running a $100 million brokerage, you're doing something right. You're doing something right in 2014. Now, that's not to say you shouldn't implement maybe a role in your brokerage who, you know, and I kind of discussed this as well. Usury, you know, somebody asked in the crowd, what's your favorite social media platform or something, and how do you feel Facebook is? And Usury's up on stage literally in front of 350 people and goes, you know what? Actually, we should have Rob Campbell right there answer this question. So they run a mic over to me, and I stand up and I'm like, oh, hi, good morning, everybody. You know, and I answered a couple of questions until I had to kill it because I didn't want, you know, I basically turned it back over to Usury. He was doing a great job. But
I was going to say, did you answer it? I want to guess how you answered. I was going to guess you said Vine, because you could do this.
Yeah, there's a lot of value there. Yeah, a lot of value in spinning Vine videos.
What did you say? What's your best platform, Rob? What's your best platform?
Well, I have to admit, my best platform now, believe it or not, I'm kind of all in on Facebook. There's a huge,
you're everywhere on Facebook, by the way, everywhere.
Yeah, and I just the way that, well, kind of Cole's notes what I said at the presentation. I said the way that Facebook works their algorithm is that the more that it inflates that post, the higher it rises to the top. So if when I posted this award shot, I had like over 100 likes in 24 hours. And why is that? Because it doesn't disappear in the stream. Facebook goes, oh, this is pretty decent. Let's keep this up top, and let's kind of repost this in people's timelines.
Visual stuff. Not to get off topic, but visual stuff on Facebook. Like, we posted a picture of our sign, and it was like the most popular post we've ever had. And it's a stupid sign. Like, at the end of the day, we like the sign. It's a sign, though. And you could post, you know, we're helping children in Uganda with, you know,
text.
Learn how to text message or something, and you're never going to get a really something insensitive. But
it's totally true. If you took a scenario exactly like you said, Gord, you're in Edmonton, right, Gord?
Yeah.
So if you posted, to give people an example who are watching, if Gord posted right now, or even Jackson with First Foundation posted it in text only, we just dropped off 200 pounds of food to the food bank here so kids can eat breakfast. And we're just using this as an example, not to play any kind of weird angle on monetarization on people starving. But anyway, if you just posted that in text, you'd get a decent amount of likes. Not a lot, I guarantee you. If you posted a photo of Jackson in his freaking Top Gun glasses, rocking the kilt at the food bank with like arms hanging down with the bags of groceries and kids there, just a photo, and said, so here's what we did today, I guarantee you it would blow up. It would absolutely blow up, because we are visual human beings. We like that engagement with photos. So that was my answer.
That's why Instagram gets 15 times the engagement per post than Facebook.
Bingo.
Even more than Facebook. Wow. So
15 times. 15.
Okay. I wonder if
That's
we should.
huge.
Privacy-
Instagram's probably one of my favorite.
Yeah. We should start taking pictures of our clients when they walk in the door of their new home and.
No, that's no.
Wait, well, something visual.
I'm so happy about all my best clients. Shut up. I hate that crap.
All right. It's a bad idea, but I agree.
We work on the same team, but yeah.
So good.
Now, Rob, who's your favorite speaker? Yusri aside, and he does a great job, so that was a good speaker. Any other major takeaways from the conference in Vegas, and any regrets?
Oh, jeez. Absolutely no regrets. I kept it classy. Although there are one or two photos floating around of me holding 2 beers and a Ryan Ginger all at once, and yes, they're all for me. But no, you know what? I'm always of the adage in this day and age, especially in our network, but not just for us, but for customers or clients or potential referral partners. You can't hide. You can't. Only now has Google started to erase people's history if they've requested it and have a good history of it. That stuff doesn't go away. So a word to the wise: if you go on a vacation or you go on one of these getaways, lender getaways to somewhere in the Caribbean or whatever, or even a local event where it's an open bar, keep it classy, because you never know who's got their phone or where the next mistake might happen. You got to keep it classy. Yeah. Always.
Yeah, good suggestion. Good suggestion. One of the other things we wanted to talk about was just Jackson CAMP, the Canadian I almost said assassination. Canadian Association. Whoa, that was Freudian. Canadian Association of Accredited Mortgage Professionals.
You want me to take over here? They released in May 2014 significant statistics.
Thank you, Camp. I love
go through these.
Thank you for the plaque on the wall. I love you, Camp. Don't hurt me. Go ahead.
So here we go. I thought this was a pretty interesting list. They came out with one of these last quarter, or a half year ago, and it was pretty good stuff. But I'm going to run through the stats. We're going to run through this. If you're on Twitter and you want to join us, hit us on the hashtag CMHTV. We'll get you on the show if you've got an opinion on this. But the three of us are going to talk about how we feel. I'm touch and feel about these statistics. So stat one: in the last year, 74% of new mortgages were fixed rate mortgages. Overall, 65% of mortgages are fixed rate, 28% variable, 7% combination. The question to you, Gord, is fixed or variable right now? Going 74% in the last year. Moving forward, are we going to see a surge of variable, or are we going to stay fixed?
You might see a few people looking to squeeze a few extra bucks out of their monthly payment for the term, but at like a really good variables to prime minus 60 right now. Versus, so you got basically a 55 basis point spread between a variable and a 5-year fixed. I think you gotta go. That's cheap insurance. That's cheap insurance. I've seen 50 basis point rate moves by the Bank of Canada. I've seen 75 basis point rate moves by the Bank of Canada. It can be over like that. And by the time you think, oh man, the Bank of Canada is going to raise rates, I'm going to lock in, the fixed rate's already moved up because the bond market anticipates that. They're smarter than you are, and they're faster than you are. So now instead of paying $2.95 or whatever for a 5-year fix, you're going to be paying 369 or something
So
like
the
that.
spread between fixed and variable needs to be greater than what for you to feel comfortable suggesting variable to clients?
Greater than 1% in this market. In the past, I've had a higher threshold, probably of 1.5 or more. But it depends. I think it depends also on the strength of the borrower. If somebody can afford a rate spike and they're okay with that and they want to take their chances, or if it's a smaller loan and they're not as vulnerable to payment shock, I'm okay with that. I think it's obviously borrower dependent. If you're right on the borderline of whether or not they qualify on today's posted rates for a variable, the qualifying rate, if you're on the borderline of them qualifying for that versus a fixed rate at 5 years, I'd suggest the 5-year fix, because maybe they're not going to be as strong in a few years. I think it's borrower dependent, but I don't feel comfortable. I don't feel really comfortable in most situations, certainly for first-time buyers or anybody taking out a bigger loan, to recommend a variable with only a 50-point spread. I just think it's too small.
Alrighty, second point. 35% of mortgage holders took steps to accelerate repayment, including increasing their payment frequency, making lump sum payments, or increasing their mortgage payments. Rob, to you, do your clients feel that accelerating the repayment of their mortgage is important? Do they ask those questions? Do you sell it? What's your thoughts on this?
Yeah, absolutely. It's more of a question with, believe it or not, the kind of the millennial generation. They're rate sensitive, but they're more so concerned about the prepayment privileges. I had a client that closed about 2 or 3 weeks ago, like literally the day after closing, called me up and said, "You said 15-15 double up, right?" Like, that's all he's concentrating on. Which is great, But I always tell people, and just to echo what Gord said, because he pretty much hit it right on the head of the nail. It's deal strength, it's client strength. I mean, are they a first-time buyer? If they're first-time buyers, I usually tell people, you know what, prepayment's very important. However, you got a lot of changes coming. For most people that move into their first home, they don't want to be house poor. There's expenses that rack up. There's potentially a growing family, so are you really wanting to prepay? So it does depend on case by case. But yeah, generally I am seeing people more concerned about prepayment privileges.
Excellent. Christine from BC says, I think we're seeing a lot more people taking shorter fixed terms. So she actually dissects that fixed versus variable, and moving into the future, she sees people taking shorter terms. There we go. Whether we like it or not, in 2013.
Can I tell you what I think the influence on that is banks. I think the influence on that is bank reps selling shorter terms because they're getting incented or pushed to sell shorter terms, because I think that's in the bank's best interest.
Well, so then we got
as mortgage brokers. I think it behooves us to think about that for our clients and sell against that. And I think the banks are pushing that, and that's why clients.
Of course they are.
Well, then that actually ties into the next stat. In 2013, 47% of all new mortgages were obtained through a bank. 39% from a mortgage broker. Overall mortgage broker share is 26%. So I'm sure that 47 and 39 don't add up to 100. So where's the other significant player lending in the Canadian market? But maybe that's mix. I'm not too sure mix.
Can you say that again? Can you say
47% of all new mortgages were obtained through a bank. 39% through a broker.
Yeah, credit unions.
Okay, credit unions. Maybe some mix there, but yeah. So I guess the question here is the mortgage broker market stagnant, or as a channel, are we stagnant? 39% seems to be a bit of a jump from 2012. So is the broker market capturing more market share? What do you think, Gord?
Yeah, and I think I saw, actually, I'm going to give a shout out to Mike Fotu. Posted this. I could be wrong on who posted it, but it was a realtor in Calgary who's got a lot of good stats, and Mike is one of them. So he's that I follow, and I suspect it was him. So I'm sorry if I got that wrong, but I believe he posted that over 50% of all of the home purchases in Calgary last year were to first-time buyers. So that's a pretty big number. Not to mention that first-time buyers choose mortgage brokers over 50% of the time, which we also know. And when you take that right there, that's 25% market share.
25% of the market. Yeah.
Isn't that? Am I doing my math right? I apologize to my grade 6 math teacher if I'm getting it wrong.
That's where I went. So, yeah.
That's about 25% market share, right there, only on first time. Just the first time buyers in Calgary. So if you add in everybody else, yeah, I can see that. I can see that working out in our favor. For sure.
Already, average mortgage interest rate for homeowners is 3.24%. For mortgages renewed in the last year, we're at 3.02%.
Yeah, so a lot of
low rates.
A lot of
I bet you that 3.02% average for renewals is shorter terms as well.
Yeah, shorter terms and variables, right? That's not a 5-year.
No, and I agree with Gordo on the whole bank using the shorter terms. It's totally in their best interest. They want to for like dumb math from my dumb voice here. They totally want to loop people in on a shorter term so that when they come up for renewal, they're hosed. They're hosed on rate because the market's going to climb.
85% of people renew with their existing lender.
Yeah.
No, there's another interesting potential strategy behind that shorter term. Christine, thanks for, by the way, always joining us every week. We love talking with you, and shout out to everybody up in Prince George. We think you guys are awesome people. I don't know why Prince George attracts such great people, but you're good people up in that country. We have I've heard through the grapevine of brokers who have a 2-year strategy whereby it allows them to touch the client more frequently. And when you think about the compensation, so if you're matching what do we get paid on let's say we get paid 85 or 90 or 80 or something on a 5-year fixed, and what do we get paid on a 2-year? 50 basis points? Is that about right? Give or take? I don't even know.
Sure.
Let's say 50. Okay, so if you can get paid 50 basis points on a 2-year and then meet with them again in 2 years, there's 100 in 4 years versus 80 or 85 or 90 in 5, and then you get to see them again in another 2 years. So you got 150 in 6 years, not including any volume bonuses or anything like that. So from a so strategically as a broker, I'm not saying to do this, and it's worth a debate about the ethical component of it and is it really better for your client or not. My understanding is, you get a chance to meet with your client more frequently. That's good for the business, probably good for the client too. Most clients are terminating their mortgages 4 years in or 4.5 years into a 5-year mortgage anyway, so you're maybe saving the client potential penalties, which is good for the client and good for you because you're helping them and you're earning a good reputation that way. That's positive. You may be in a situation where the rate savings are there. I haven't looked at the stats to see if a 2-year is consistently saving people money over time versus a 5-year, like a 1-year often is, right? I've seen stuff in the past where if you just did a whole bunch of 1-year terms back to back to back to back to back, you're going to end up statistically better off than you would in a 5-year. So there's savings there to be had. That's good news. You're making more money. That's good for you. Like I don't see the downside, and my understanding is
here's the downside.
Talk to me, because the competition, the other component to it is the competition is not competing on a 2-year rate. Right?
Yeah, here's the downside in this market though. Every 2 years you got to qualify them on the 5-year posted.
Bingo.
That's the big curve.
Right? It also presumes you're moving them every 2 years, so you're bouncing from lender to lender to lender to lender.
4-year, I get it. 4-year, I get it because the stats are against people, right? 6 out of 10 people break. So maybe that 4-year is a better option. The 2, but it all comes down to qualifying.
Sure, it does come down to qualifying, and financially, one factor people are going to have to consider is this is a business, right? You're selling a 4-year and making 60 basis points or whatever it is, or 2 consecutive 2 years. That's a 40 basis point difference off the top. That's a big chunk of dough. That's like 50% or so of your revenue. So I don't know. It's interesting strategy. I'm just putting it out there. I'm not saying yay or nay on it. I just think worthwhile considering, and maybe if it fits for some of your clients, it might be a good competitive strategy as well. What are your thoughts?
With the
Jack?
interest of time, because I think we're running a little bit hot, I'm going to combine these next ones. 87% of mortgages have amortizations of 25 years or less. For homes purchased in the last year, 92% have 25-year amortizations or less. More than 80% of Canadian homeowners have 25% or more equity in their homes. That's a tough one for me to believe, but yeah, I guess that's skewed because I would typically deal with a first-time home buyer putting down 5%, and that's been the majority of my business. Estimates suggesting that 2013, 625,000 to 650,000 homes were bought. Among homeowners who purchased in the last year, 55% were first-time home buyers. So that goes to your stat there in Calgary, Gord.
That's great news for mortgage brokers, because I think we were all wetting our pants a little bit when a lot of the mortgage rule changes came out. We thought that's really going to kill the first-time home buyer market. Apparently not. That's pretty good.
Yeah.
Pretty good numbers. I just wanted to back up though, Jax. I know we're tight for time, but whatever. We're having a good show. We're having a good conversation. People don't have to watch the whole thing if they don't want to. I'm sure they know that. Let's talk real quick about the 80% of homeowners having 25% or more equity in their homes. I've seen that stat 100 times. It's absolutely true. And in fact, I think we'd be shocked. I think the overall average loan to value is quite low. It's quite low across all categories, across all homeowners. Now, some of that is because we've had a lot of appreciation in prices. So, if that cooled off, some of that would go away. But I know even internally, and we deal with a lot of first-time buyers too, our average loan to value is below 80%. We're closer to 75% average loan to value with our whole client base if we go through our database. So I believe it. Carry on.
Well, here's an interesting comment on the Twitter from Dayquill. That's Darren Quilley. He's in our office as well, so this is quite the First Foundation show. He says, Gord, some lenders will not take a 2-year switch. Hashtag CMHTV.
Wow.
How about that?
They won't take it to, what?
Some lenders will not take a 2-year switch.
So I've got a client, somebody's at RBC, and I want to move them to FirstNat for, I don't know what FirstNat's
That's on. Right. Actually, that's very true. Quigley, the man. That is very true. I want to say that it's actually a 3-year minimum.
On switch?
I want to say. Yeah. Yep. A straight switch, year for year, dollar for dollar. I want to say that it's a 3. And take this from the guy with the sieve for a brain when it comes to underwriting. But I'm pretty sure it's 3-year minimum.
Nice to know. I have people I'm paying a salary to watching the show. That's good. Thanks, Derek.
And Dylan doesn't communicate on Twitter again. There we go.
He's probably going to bill me for this for training too. So it's a double win for you, Derek. No, but excellent point. I'm glad you brought that up. Thank you.
So what about this one? This is one that I'm not too sure about. Canadians look at their homes as 69% the place to live and 31% an investment. I guess from my experience, people are buying a home because they don't want to rent, and homes always appreciate, and I'm throwing my money away if I'm renting, and I'm saving money if I'm owning my own home. 31%, only a third look at it as an investment, whereas 2/3 are looking at it as just a place to live. I don't know, that one I'd like to see the wording of the questionnaire on that one, because that seems a little foo-foo.
Well, and maybe they're both, right? Maybe it's a bonus if you get something out of it at the end of the day, but you haven't thrown your money away.
So the question is, should people look at their home as an investment, as a cash machine? Because one of the stats here does say in the past year, 11% of homeowners took out equity from their home, with the average amount being $51,000. The number one use for this equity takeout was debt consolidation. I don't think it's nearly as bad as it was in 2008, 2009,
right.
But still, 11% of homeowners are using their home as a cash machine.
Well, and those cash machine or not, I think those, that situation didn't definitely help people out of a tough position, but it's not always because the equity isn't always there, right? In this marketplace, we just went through 5 years where people couldn't do that because their homes were worth less than they were 5 years ago. So now the values are.
But if 80% of homeowners have 25% or more equity in their homes, that's 80%. That's an A. That's a majority. That's as good as it gets.
Oh yeah, but those are the ones who don't need debt consolidation either, because they're responsible with it. And I think I think I don't know what I think. I have no idea.
I think it clearly comes down to the person or the couple. I think that people now more than ever have to consult with a good team, a broker and a good realtor that the broker is working with to kind of assess the situation. I think if I just had this conversation today, actually earlier today. If you're buying a home in an appreciating market, but the home is, or a flat or an appreciating market, but the home is under a little bit of stress as far as needing replacement, items to be replaced. If the home's 20, 25, 30 years old, there's some money you're going to have to sink into that home to get it back up to par, right? And then you've got to really consider, you got to run your numbers. You got to go, is our market due for another 3 to 5% increase in growth? Are we going to be flat? Are we going to see negative price growth? And then is that a worthy investment to put that money into the home? So it does really depend on the city, the market, and the home. And at the end of the day, what do you want? What do you want? What do you and your family want? What do the clients want? Do they want a safe neighborhood for the kids to grow up in, or do they even care? Is it just a shell to ride that growth up? It really does depend on the mindset of the client. And age of a home and neighborhood does definitely affect your investment. If it's an older house, maybe you've peaked. Maybe your neighborhood's peaked. Maybe that is a good time to sell and get out, and before that kind of resets.
That's good. Great point, actually. Great point.
Well, there we go. The last stat on the looking for a new normal in the residential mortgage market by Camp says mortgage credit growth is projected to slow to 5% in 2014 and 4.5% in 2015. As of February 2014, there was $1.23 trillion in outstanding mortgage credit.
So I love the use of language is really important here, and you have to read these carefully because some people might read that too quickly, as I did, and say mortgage growth is projected to slow by 5%, which is incorrect. It's going to slow to 5% growth. Hey, 5% growth is if you had I don't think our GDP growth is 3 or 4% yet. Like that's a good strong economy. When you've got as mortgage brokers now. All of the pros and cons of mortgage credit growth. But for mortgage brokers, we make our living on mortgage credit growth. If we got 5% growth and 4.5% growth, that's good growth. That's really good growth for us. So the percentage of that we capture is going to be key, and I think that's positive for our industry.
I'll say this as my last kind of comments. I think we're going to see, I can only speak in my area. I can't speak nationally. We can never speak nationally. I think in my area we're going to see growth slow down as far as appreciation of values. I think as mortgage brokers, I'm concentrating more on I'm concentrating more on phoning past clients, staying really nice, warm and fuzzy with past clients, building my business that way, being social as much as I can. I think we're going back to basics. I think Twitter, I think Facebook, I think Instagram are great touch points with people, but we can't forget this. And if there's one thing I really picked up from the event in Vegas, it was a lot of people are just taking it back to basics. Touch the client as many times a year as you can, and that's why it's so important to watch that Castle episode last week. I was not on the show. Awesome content. You need to watch that show from last week and read up on it because it's mega. If you're going to touch the client 12 to 15 times a year or 16 or 20 times a year with calls, emails, newsletters, look at Gord's laughing because I said touch the client.
No,
grow up for crying out loud.
I'm laughing because Darren Quilly said he heard Jackson complaining through the wall. I'm like, when don't you hear Jackson complaining through the walls?
That there is a true fact.
A true fact. So no. Anyway, to summarize, make sure you're in front of your clients all the time because we need to grow that broker share, and the only way we're going to do that is by not letting them forget us. And I'm guilty of that, so I'm working really hard at doing that.
All right. Well, I think that's a good place to end, and I think just a little piece of advice for all the brokers out there: kick a banker in the butt today. Do it nicely with love, but do it, and have a lot of fun out there, and take care of your clients, and everything will work out. Have a great week, guys.
Goodbye.
Goodbye.